Hi, everyone. Good afternoon. Good morning, depending on where you are in the world. We're just going to wait a couple more minutes for some people to trickle in. We'll start at about 3 past. Thank you all for being here. For those of you trickling in, welcome. We're just going to wait a couple minutes to get started and let some more people trickle in. Just going to wait a couple more minutes and we'll get started. All right, so it's about 3 past, so I'm going to get started. Thank you, everybody, for being here today. My name is Geoff Bruskin. I am the founder and owner of White Tiger Connections. We are a consulting agency that works with the accounting and CPA profession exclusively. So I'm going to do about a 30-minute presentation today, and then the latter half of the hour we have scheduled will be a Q&A. So give all of our attendees an opportunity to ask any questions in the chat, and we'll just have a dynamic back and forth, and I'll answer any questions that I can. Before I get started, I want to say a big thank you to CPA Directory for marketing this webinar for us. White Tiger, which is my firm, and CPA Directory will do a lot of these co-authored webinars together. So a lot of you I know found the webinar today through the marketing, the emails that they send out. So thank you for being here, and please look out for more webinars from us in the future. We'll be getting our CPE credit certification in short order. So we'll be able to have a good reason for you to attend our future sessions. So the topic for our session today is low market mergers and acquisitions within the public accounting profession. Public accounting mergers and acquisitions is a lot of what my firm does. At White Tiger, we work predominantly with firms ranging in size between 100,000 in top line revenue and 5 million in top line revenue. So we certainly specialize in what we favorably call the low market. I'll tell you a little bit about myself. I'm sure you're curious as to my background. My background is I came up as an executive recruiter. So I recruited for predominantly technology companies early in my career, and went into middle market recruiting after that in my mid-20s. And about 4.5 years ago, I opened up a generalist recruiting firm where we did a lot of work in financial services. And I was very fortunate to encounter a retired PwC partner who, in his retirement, he did strategy work for large public accounting firms in the New York City area. I myself am based on Long Island, and I got to shadow him in sizable M&A transactions with $100 million firms buying firms between 3 million and 20 million in size. So that's where I got to cut my teeth watching how sourcing worked, diligence worked, valuations, ultimately what it took to get to a signed offer letter that was mutually beneficial between seller and buyer, and then also into the integration process and ensuring that the seller and the buyer were happy, and most of all, the clients were happy in the transition, which obviously is what all of us are the most concerned about, or at least we should be. So that was about 3.5 years ago, and since that time, my firm, White Tiger, we have been hyper-focused on serving the accounting profession. So we folded up all of the other business we were doing, seeing tremendous opportunity here, and we've never looked back. So we still have relationships with firms up to about $250 million in size, 100 million to 250 million. We do a little bit of work with. We also work with private equity. We work with financial services. But the supply side of what we do is always with accounting firms. So we sell accounting firms to all of these various buyers. We also do partnership creation between accounting firms and these, either other accounting firms or non-accounting firms. And we do recruiting. So that's a little bit about our background, just some context for you all. So I want to start here by talking about some of the trends in the sector that we're seeing. The biggest thing to say is that there is a tremendous amount of consolidation happening right now in the accounting sector. I actually believe that it is the #1 M&A market in the country right now, possibly in the world. And that's because there are simply so many accountants who are baby boomers and who are thinking about retiring, even we have a number of clients who are in their 30s and 40s and who are running a small firm today and are just burnt out and they don't want to do it anymore. So there's a tremendous amount of sellers, and buyers see a strategic opportunity to do roll-ups in the sector. Sometimes we work with small accounting firms, a $3 million firm that's looking to become a $30 million firm, largely through acquisitions. We do a lot of that work on the buy side. And as I said, we also work with non-public accounting buyers as well. So while there is a tremendous amount of supply, there is also a tremendous amount of demand if you know where to look. So that's the first point that I'd like to make. One of the other trends that we see is that sellers typically want more cash and more and higher multiples, which makes a lot of sense. And buyers want the opposite. Buyers want to pay you less cash, and they want your exit to be based on collections. And they want the seller to carry most of the burden when it comes to the amount of cash that is being paid into the transaction, which makes sense. Sellers want more, and sellers want the buyer to bear more of the risk, and the buyer wants the seller to bear more of the risk. So we're going to talk about some of that today, but that's a general trend that we see, and I think it's a logical one on both sides. Next up, I want to talk about what drives the valuation of a firm. I'm sure a lot of you are very curious about that. And I'm sure you have opinions about it too, having been in the market for a long time. If you're attending this webinar, you probably run a firm for a fair amount of time, probably decades and decades. So I'll talk a little bit about what drives the value of a firm today, and kind of what the valuation situation was in the low market of public accounting before COVID. The major difference between before COVID and today is that before COVID, it was common for sellers to get between 50% and 100% of cash on closing. For whatever reason, this was what was common in the market. If you bought a firm in the last 10 years, but before COVID, that is, between, I guess, 2013 and 2019, let's say, it's quite possible that you paid between 50% and 100% of cash to buy that firm, and that's just the way that the market was. Today, in the post-COVID world, the market standard for a down payment on a low market accounting firm, so a firm under $5 million in top line, is between 10 and 33% of the value of the firm as a down payment. So that's a big difference between 50% and 100%. And my best answer at what drives that is really that the supply of accounting firms that have gone onto the market has advanced quite considerably. So buyers, strategic buyers, know that there are enough firms on the market that they are able to pay less cash, bear less risk, and of course, what this means is that the seller, you, are incentivized to remain involved in the business for a period following the exit. And I know that may not be what a lot of you are looking to hear. What we talk about, my firm, with sellers in the market is probably a pretty equal split of people who want to be done. They're just, you're totally ready to go golf or spend time with your grandkids. And the other 50%, maybe you're looking to have a better work-life balance, that old elusive trick, where maybe you don't have to do as much compliance, maybe any compliance work. You don't have to do as much review work. Maybe you just want to manage client relationships. Maybe you want to just do new sales and be able to pick up the phone as it comes in. So one of the things that we have had a lot of luck at doing, because the amount of cash is lower that a seller is going to receive, is structuring the transaction so that if you want to remain involved, which of course the buyer is going to want, at least in some capacity, to assure client stickiness, right? Really, the structure of what your involvement looks like post-integration is something that we have the ability to advocate on your behalf in order to achieve. I don't want to just talk about shamelessly what my firm can do for you, although we would certainly love to represent you. You should think about that yourself. If you're talking with buyers independently, it's okay to take a smaller amount of cash. That 10 to 33% is standard. But the exchange for that is you really should be able to dictate what your post-integration future looks like. I know I'm a little all over the place here, but I'm going to jump to another topic that I'm sure some of you are curious about, which is, what does your compensation situation look like after a merger? If you're going to be only taking 10 to 33% of cash down, are you being compensated to help retain clients? And the answer to that question is yes, you are. Typically, a seller in a post-integration firm will have three forms of compensation. You will have a base salary, number one, which could either be an hourly rate or it could be a base or a draw. You will have a bonus. The bonus is tied to bringing in new business for the combined firm. And you'll have your vesting cycle, number three, which is the payout of the delta over whatever. Let's say if you got 25% cash down, the remaining 75% of the value of your firm is going to be paid to you as that third form of compensation over the period that you remain involved after the sale. So rest assured, if you're going to continue working, you're going to be paid for your time as well as for the value of your firm. And as I said, something that my firm excels at is advocating on your behalf to ensure that the situation you're in, you're not working a 60 or a 80-hour busy season on a weekly basis. You have a more relegated work-life balance. And the reason for that is because the buyer has the infrastructure to be able to support a lot of the work that you're doing that, truth be told, you probably shouldn't be doing as the owner or a senior partner in your firm. Okay, so let's see, where am I? Let's talk about what drives valuations and what the valuations are. So in the low market, as I said, what we codify is between 100,000 in top line and 5 million in top line. Typically, what we see is the multiple for your firm being taken as a multiple on the gross revenue, not on the EBITDA. Somewhere around 1 million, 1.5 million, 2 million in EBITDA, the multiple will change between being taken on the gross to being taken on the EBITDA. I could talk for a long time about why and when exactly that transition happens. It's a gray area, truth be told. The main reason for it by the open market standard is that with enough freestanding cash flow in your firm, and this is true not just in the accounting profession, but in all mergers and acquisitions markets, with enough cash flow, a buyer has the ability to bring in strategic staff to run the firm so that the buyer themselves does not have to. So whereas the gross multiple on low market firms is between 1 times gross revenue and 1.5 times gross revenue, that's the typical gross multiple that we see. The multiple on EBITDA is going to be much higher than that. It's going to be between 3 and 10 or 11 times EBITDA. And that's only relevant to you, perhaps, if you're doing north of $1 million in EBITDA. And I can get into on another webinar or on a private conversation with any of you exactly why and when that would take place. But for this conversation, because many of you on this call will be under $1 million, $1.5 million in EBITDA, and therefore fall into the gross multiple population, let's talk about that difference between 1 times gross revenue and 1.5 times gross revenue and what drives that. So there are a number of variables that implicate your gross multiple, and I'm going to go over some of them. So one is how much subscription revenue is in your practice. The more stable and subscription revenue that's in your practice, the closer to that 1.5 multiple you're going to be. The more seasonal revenue that you're deriving from your practice, the closer to that 1 times multiple you're going to be. So certainly the tax compliance driven practices are going to be closer to 1, whereas say bookkeeping or fractional CFO or accounting services or subscription oriented tax advisory services are going to be able to come closer to that 1.5. So that's a major variable. Another one is how much value do you derive from each individual client? The lower value, higher volume firms, so the retail tax practices that do many lower value returns are certainly going to be closer to that 1 times multiple. While the firms that have higher value clientele, if you're doing 1040s that are north of $1,000 or $1,500 is the standard. Your minimums are close to $1,000. You do some advisory work as well. Maybe you have accounting services that underlie your practice. You're going to be closer to that 1.5 number. That's another major variable is the value of each individual client that you have. And let me give you one more. So another major indicator is how remote your practice is, specifically when it comes to the infrastructure of do your clients come into the office to see you and to see your staff. The more in office your client relationship management is, the lower the value of your practice. It's going to be closer to that 1 times revenue multiple. I'm not sure why my face just appeared here, but here I am. The closer to that, let's see, and the more remote that your client relationship management is, the closer to that 1.5 multiple you're going. Let's see if I pick this up. It's just distracting. Let's see. All right, well, that's less distracting. Sorry about that. Okay, so that remote one is worth double clicking on and sharing some more information. The reason for that, and I'll go through each of them in just a little bit about the thought process that buyers have behind why these 3 variables are major drivers in the sliding scale between the 1.5 and the 1. Many of you, I imagine, will have a practice that is in a rural or maybe a suburban area where there are not many accounting firms in your area. This is probably a major reason why you have struggled with staff. We know that we all talk abundantly in the accounting world about how difficult it is to come by staff in today's market. And it's a reason why you probably your phone probably rings much more than you know what to do with, and it's a travesty, but you end up being selective about which clients you can take on because unfortunately your bandwidth is something that you need to think about very, very seriously if you want to be able to sleep at night. So, the buyers, and I say this as respectfully as I can, they don't want to inherit your problems. So if you have the challenge of, well, I would need to bring in more in-office staff, and that's really the culture of our firm, and that's the expectation that our clients have, a buyer is going to be reticent about buying a firm like that. Doesn't mean that we can't find a buyer, and it doesn't mean that there aren't buyers that are out there. They are. It's going to be difficult to sell a practice that's very physically oriented in a non-metro area. That's just the truth. And as we say, it's going to drive the value down because a buyer is going to be looking at that as a major risk profile because staff is such a challenge. Just like it is for you, it'll be a challenge for them. On the subscription revenue side, I think it's obvious, right? The more cash flow consistency that's in a practice year round, the more comfortable a buyer is going to be paying a premium on your practice at that 1.5 level or close to it. And the same thing with the value of your clients. That is in a positive and in a growth mindset. A lot of buyers are going to be thinking about your clients as sources for being able to provide additional value to them or upsell additional services. So we work with, as I said, public accounting firms buying public accounting firms, financial services firms buying public accounting firms, and in some cases, private equity buying public accounting firms. And the model is, and this is true even now in many regional public accounting firms, if you're doing CFO services for, I'm just going to pick, and let's say construction companies, a public accounting firm or a financial advisory firm, let's say, has the ability to upsell something totally unrelated to finance. It could be IT, it could be marketing, it could be outsourced HR to a construction company. And if you're a buyer and you're listening to this, that's a strategic consideration that you should have as you think about what you might want to be purchasing. The financial advisory and public accounting partnership is one that we see a lot of interest in right now, more on the individual side with things like asset management and insurance sales, but also with things like being able to provide corporate insurance policies. So there are tremendous cross-selling opportunities, which if you're a seller on this call, you may have, feelings about that one way or another. Many of the sellers we work with are reticent about, breaching what is a fiduciary line as they see it. And I can certainly understand that by wanting to be a part of a team where there's financial implication in selling an additional service. And other sellers that we work with see no problem with that. Say, as a matter of fact, wouldn't it make more sense if, for example, the financial advisor and the accountant were a part of the same team and able to, walk across the hall in order to get a hold of one another and provide accounting services and tax advisory, all rowing in the same direction on behalf of the client's best interest. So that's a personal preference, and it's something that my firm works with on a case-by-case basis with our clients to make sure that we're meeting your expectations. For you, if you're wanting to work independently, which I certainly empower you to do, you need to come up with a strategy, and I'm more than happy to have a call. And there are other strategists in the market which can advise you as to who might want your firm and why. And that's something that you should think about. The biggest takeaway I hope you all have from this session today, if you're selling your firm and maybe you're thinking about selling your firm and you're not sure if there's an appetite for your firm or if there's an appetite, I want to encourage all of you that there is light at the end of the tunnel. You don't have to simply turn out the lights. And that's my least favorite thing to hear from people. It breaks my heart because all you sellers out there, this is your life's work. This is your baby, and you should be compensated for that. And I know if you're listening to me, you're probably saying, well, I should be compensated, but who's going to want my practice? Have a conversation with me. because it's quite likely that someone will want it, even if you're even a retail tax practice. Open-mindedness is actually a lot of what's required for success in some of those outlier regards, but we can talk about that another time. Let's see, what else? Okay, if you're a buyer, what can you do to draw the kind of sellers that you want to attract? What sellers look for? Sellers look for great culture. That's the number one thing that I hear when I'm talking to sellers about what they're looking for. They want a good fit. They want a place where their clients are going to be serviced at a high level, so there has to be competency. They want a culture that their clients are going to be able to get behind and that it's going to feel consistent with the kind of service that they've been receiving over the life cycle with the seller. And they want a culture for themselves, which is going to be great because, again, if they're going to have to take a minimum amount of cash and remain involved in the business post-integration, there needs to be a culture that is going to provide them with some freedom and elasticity that maybe they have not been receiving while they have been working themselves. And if you're a seller, something that you probably think about, and this is for all you buyers out there, is why do I have to sell it all? I could, if I'm only going to get 10 to 33% of cash down, wouldn't it make more sense if I just kept working until I was ready to shut off the lights? Because am I going to make more money not selling and just working for X number more years than I would make in a sale? And then I don't have the risk that's associated with a sale. I hear that all the time. So for a buyer has to be able to provide a seller with a roadmap that is going to be financially beneficial to the seller as well as culturally beneficial to the seller. And accountants, all of you listening, you know this. You are you don't take no BS. You can smell that a mile away. So again, let me just say for the sellers, there really are some great buyers out there that want to provide you with a phasic retirement, where you're going to be compensated on a financial basis to make it worth your while. Your clients are going to be taken care of, and you're going to be taken care of. I hope it doesn't sound too good to be true, because it's not. It is out there. Okay, let's keep going. What are the objective realities of deals that are currently happening in the sector? I think we talked about cash down. We talked about post-integration a little bit. Okay, what if you are not ready to retire tomorrow, but you're looking for a succession plan within the next 2 years or 5 years or 10 years? What are some of the options that you should think about? So I'm going to talk about a few different options if you're not quite ready to sell your firm yet, but you're starting to think about it. So one option that we probably hear the most about as the preferred option is talent acquisition as a succession planning solution. And remember, my firm does recruitment. That's actually my core competency. So I know a lot about recruiting in the accounting world. It's gotten progressively more difficult, and you may have been trying to realize talent as a succession planning solution for yourself for years. Maybe you've been effective, maybe you haven't. Maybe you've been effective, but the person who's going to become the new partner or managing partner of your firm doesn't want to buy the firm. That's another possibility. Or maybe you just can't find anyone. Maybe you've tried and failed. The truth is, talent is an option, but it is a very difficult option in today's market. There are very few firms. I would say less than 10% of the firms I talk to in that $100,000 to $5 million top line range that have been successful in finding talent as a solution to their succession plan. And this proves a very troubling existential question for the sector. It really does. But I want to talk about the value to you more than I want to talk about the future of the sector, which I think exists. It's just going to be very different than it is today. For you, if you are really gung-ho about talent as a succession solution, we should have a conversation. We should talk about it. If you are open to talent on a fully remote basis, and I know that probably sounds like craziness to a lot of you who are physically present, there are a lot of firms right now, most of the ones that are successful in bringing in new talent, hungry, self-motivated, high character accountants with licenses that want to be partner that may not be in your physical geography. So that may not work for a lot of you, and it may work for some of you because you have enough remote infrastructure where that remote talent solution could be something that helps get you to a succession plan. Absent of that, it just depends on where you are. The closer to a metro you are, the more likely it is that as long as the numbers make sense for the buyer, aka the new hire that you're looking to onboard, it's possible. It is. The more remote of a geography you're in, it's a pretty tall order. I will say that. So merging instead of selling is another option. If you're thinking about, a 2 to a 10-year retiring plan, you don't have to sell your firm. You could merge your firm. And what are the differences between a merger and an acquisition? At the end of the day, it's really just, I guess I was going to say semantics. It's kind of the best way to explain it is it's a different psychology of the transaction. A merger ends up being more about your continuity in the combined firm and less about your succession plan. So if you're planning to retire in the next 2 to 5 years, you're really looking at an acquisition. If you're planning to retire in more than 5 years, you could be looking at a merger. And in a merger, you could have administrative support that you don't have right now. You could have compliance support that you don't have now. You could have review support that you don't have now. And you could do things like just manage client relationships and pick up the phone when it rings, and continue to make the same amount of money that you're making right now. For those of you who are younger and listening to this, you could even make more money through a merger than you would make on a trajectory where you stayed independent. And that's because, as I said, a lot of buyers, both public or merging parties, both public accounting, private equity, financial services, are going to want your firm because there are significant cross-selling and upselling implications, or they want to use you as a platform to do more acquisitions, more mergers. And with one successful under their belt and you being an advocate for their developmental strategy, they have the ability and the reach to now get in front of more people. They want to make you very happy because you're their first success story, or maybe you're their 5th success story, and they want to use you to help amplify the reach that they have and grow even more. Obviously, client service for you has to be paramount. But anyway, this is how a lot of buyers think. And finally, I think the last option is, even if you're, not planning to retire imminently, you're just thinking about the future, you could sell your firm and stay on for a very healthy final chapter. If you're not ready to retire for 10 years, let's say, but you really are only interested in some kind of a transaction because you want to secure your succession plan. Maybe you have some medical issues that you're going through right now. Maybe you don't have medical issues, but you want your estate to be covered in the event, God forbid, that something happened to you. Maybe you want your clients or your staff to be covered. God forbid something was to happen to you and there's no one else at your firm who would really be able to take up the mantle if for any reason you weren't able to work. These are all great reasons to consider a merger, because with expanded infrastructure, you have your clients, your estate, you yourself have the ability to get through rough patches where all of the weight of your practice's continuity doesn't fall onto your shoulders. Let's see. And I think I'll close with, and I'm a little over half an hour, but we'll still have time for Q&A. I'll just close with one last point and tell you all a little bit about how my firm, White Tiger Connections, works with buyers and sellers of accounting firms. So one thing that we are not is we are not a highly transactional brokerage shop. I'm sure everyone on this call has heard of accounting practice sales. They are a great transactional broker that works across the country to help buy and sell accounting firms. My firm, we are much more advisory oriented than we are transactional. A statistic that I am not proud of, but that's very true, is that 75% of sellers in all mergers and acquisition scenarios end up being unhappy after a transaction has occurred. And thus far, 0% of the M&A parties, both buyers and sellers that we have facilitated, have been unhappy after the sale. That is because we are a dedicated consultant. We don't have to be exclusive, but we are a dedicated consultant on your behalf that will work with you until the bitter end, ensuring that you are happy and that everything that has been promised to you, whether you are a buyer or a seller, is actualized post-integration. And that's really all there is to it. We can get into more details privately if you're interested. All right, everyone. Well, it was a pleasure to spend some time with you. Wishing you a great weekend, and look forward to seeing you all again in the future, I hope. Take care.